Rich, first of all, thank you for hosting this podcast. My wife recently told me that I have a face for radio, so I feel like this format will be particularly effective for somebody like me. Well, listen, going back to your very apropos intro, like you said, back in November, we published our Outlook report where we were just very concerned about the impact of higher valuations, really higher interest rates, and higher inflation, and the impact that has on equity multiples. And you have to go, many decades of history. The batting average has been 1,000 in terms of the impact that has on multiples. So after being, uber bullish for so many years, 5+ years in transports with respect to the outlook for equity values, we threw a little bit of the yellow flag, as you said, cautioning people and really our client base on the implications for multiples. Now, fast forward, 4 months, and we're kind of in a different world. Inflation is at a 40-year high. Everybody's discussing about the magnitude of rate hikes in March, where potentially there's some obviously very big geopolitical concerns. And we've seen that derating across a lot of our coverage. Just at a high level, broadly, the S&P 500 was trading at 19 times 2023 earnings back in late November. Today is trading at 17 and a half times. And, that essentially acts as gravity for a lot of different stocks in a lot of different verticals, and particularly ours. So it's no surprise today, as we sit here in the middle of February or a little bit after the middle of February, seeing a company like Saya down 22%, seeing a company like Old Dominion down 20% on a year-to-date basis. It's just been a very difficult tape for the macro forces that are at play. The good news is that I think moments like these create compelling opportunities where conviction really matters. And so what we're looking for in terms of your comment about being selective, we're looking for companies that have the potential to earn significantly more money than they are today over the next 4 or 5 years, either through structural change or cyclical factors. And it's really structural change that we're looking for, because obviously it's difficult at this point in the cycle to argue for a cyclical acceleration. And so we think we have identified those ideas in the form of companies like Saya, companies like Knight Transportation, companies like XPO, where we think there's a huge opportunity for narrative change over the coming 6 months. And so we're sticking to that selective approach. We're sticking to our conviction, and we're not letting this year-to-date correction in the market change our view on earnings power over the next several years, because we think what's happened over the last couple of months could have been highly predicted given the inflation environment that we were in and the likely easing of monetary or tightening rather of monetary and fiscal policy.